Hi, today's topic is why so many business reports are wrong and the High Court decides, particularly in business valuation related matters. Let me show you why. Spencer's case 1907, valuations must be based on the interpretation of market activity. And numbers used in reports presented to banks, lawyers and courts are not market related. In the recent Australian High Court decision in Place's case, it confirmed, or they cast doubt on balance sheet approaches which are residual methodologies and rejected discounted cash flow due to its unreliability. However, if you can get this right and understand why it is so, you will never be duped again. Please look at the trading statement on your screen and ask yourself, what is the most reliable and provable figure on that statement? Now careful. I hope you were able to recognise sales. Congratulations, because it is the only figure that interacts with market, and it is evidence of market activity by management via the employment of all other assets, Spencer's case. All of the other figures on the trading statements are products of management and are subject to manipulation. So why do most trade the most provable number for the most unprovable? What drives people to accept a lower suspect view? Maybe they have never been able to see the difference. Only accept valuations based on the most provable figure. Never go lower. Never accept valuations based on suspect, manipulated, non-market related figures. Always focus on facts and legal backing, as in Spencer's case. If you can't prove the numbers, don't use them. Secondly, what is the most or the second most reliable figure on that page, but is always wrong, yet is a strong indicator of value? Careful again. I doubt whether too many will guess this, but I hope you selected depreciation. If you did, then you are switched on. Why? Because that number indicates high tangible asset values, yet is ignored by most. So now, let's see how we translate numbers into values. If you look at the diagram on your screen between two businesses, please look carefully. The two businesses are in the same industry. They have the same turnover or sales. One claims 50K in depreciation and the other claims none. But you cannot follow accounting and taxation concepts. They mislead, distort and confuse real market values. Plant and equipment must be valued separately at today's market value. Business A has new equipment. Business B has older equipment, but still produces 1 million in sales. Goodwill value is the same, and it's not based on net profits. Valuers should use provable numbers, not suspect numbers, yet this method is simply the inverse of the other. Always use the best, not the worst. Now, many years ago, I was involved in a family estate matter whereby the oldest son was left the family business and the other two siblings the family home. The older brother claimed that the business was not worth anything and produced an accountant's report claiming to be a valuation that supported the notion the business had no value. The accountant had never inspected the business, nor did he compare financials to industry numbers. I was instructed to value the business by the opposing solicitor representing the siblings, It was clear from the beginning that the business owned substantial plant and equipment assets and had large volumes of stock on hand. The plant and equipment assets were in excess of 250k, and stock levels were overly high given the production of the business. When I valued this business, I discovered fraud. Now on your screens is a simulated statement that will show you what he did to negate earnings and trade at a loss. He purchased almost double the amount of stock needed to run his business and recorded it in his financial statements. But he sold the extra stock to a friendly party within the same industry for cash, which he kept separately. None of this would have been detected unless market comparison techniques were employed, which incorporates profiling and benchmarking. Please see the figures highlighted. The problem, as I see it, within the legal profession is that they seem to accept reports from non-valuers and presume they are correct, or they do not challenge a report because they do not know what questions to ask, nor do they challenge their qualifications, training, or the contents of the report, or the numbers they use. This next case involved a family law matter which involved business interests. Again, an accountant representing the wife's interests prepared a report for the wife's solicitor, which in turn was forwarded to the husband's solicitor, who commissioned me to prepare a valuation of all assets. The opposing accountant had never inspected the business, nor any other similar businesses within the same country town, nor read the lease, nor any comparison to any other. He then produced a report based on EBIT methodology and used 2 industry averages, with no evidence of where they came from to support his method, and claimed the business was worth 345k. But the stupidity did not stop there. He then cited that an additional 50k should be added to the value of the business because he found that money in a separate bank account. He then adjusted the business value to 395k. So, who among you would take money from your bank account and give it to the purchaser? No one, I hope. This matter settled in favour of the wife because the husband's solicitor did not know enough to challenge the other report in court, despite numerous counselling efforts and his inability to distinguish between tangible assets and intangible assets and how to measure them. Banks, lawyers and judges should always reject reports and valuations based on suspect, lower residual numbers instead of prime, provable numbers, and the lack of evidence about tangible asset values. I used to say sales, but now I enlarge this concept to completed sales and to arm's length sales because of my inability to trust accrual accounting. The only figure that is trustworthy, provable and reliable and is based is market-based or derived is turnover. All the others are manipulated by management, and to use lower suspect numbers will always distort and mislead. So my advice is to throw out any reports that are based on lower suspect numbers and non-market related figures or methodologies. These include EBITs, EBITDAs, discounted cash flows, add-backs and future maintainable earnings, or any balance sheet approaches which use discounted written down values, top down, bottom up methods, anything to do with residuals. Logic itself should tell you never trust numbers based on the future. They are pure guesswork or fortune telling. The High Court in Places decision rejected discounted cash flow and the reliance on projections, stating unreliability. Therefore, if they use these lower suspect numbers or methods, they are fooling you, and you have just been duped because you lack superior or sufficient knowledge to combat or challenge such. but not after today. There is a massive problem with using balance sheets or top-down or bottom-up approach. All assets should be valued at current market values. The High Court reaffirmed Spencer's case. Valuations should be based on markets. Balance sheets record the historic price paid for property, buildings, and plant and equipment. Balance sheets only recognise purchased goodwill, not internally created goodwill. Balance sheets reflect accounting and taxation concepts, and they will never reflect market values. Current tangible market values will always disagree with balance sheet values or written down values of plant and equipment. Now, no one can escape what was used or accepted in the past. Banks, loans, law firms, judges, court judgments, governments, partnerships, divorce settlements, the list goes on. But if you have accepted, prepared, or endorsed such reports knowingly, then it is possible you have misled others. The High Court in Places decision has stated that legal goodwill is distinct from accounting goodwill. So let's look at what the accounting industry thinks it is. According to AASB 1013 definition, goodwill is the future benefits from unidentifiable assets. According to this, the accounting industry cannot identify what goodwill is. They claim it is unidentifiable. They do not know what the future benefits are, nor do they know how to identify goodwill. When you do not know what creates goodwill, or there is no consensus whatsoever on what it is, how can you claim to understand it or value it? But I say goodwill is identifiable, and its identity is sales, based on market transactions, as in Spencer's case 1907, and its source, an attractive force which brings in custom, according to Muller 1901, again confirmed by the High Court in Placer-Dome Inc. There is a safe way to arrive at the truth or true position, and that is to ask or instruct experts for a tangible asset valuation and an intangible asset valuation at today's date, and insist on their qualifications, training, and ability to do so. It is my aim to support the legal industry and give assistance wherever possible, to identify suspect business valuation reports and to enumerate why. That concludes today's presentation. I hope you get your copy of my book soon. Thanks for watching.